45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Let's get started, guys. Thank you for joining us. Got a very interesting presentation which is on single family or multifamily investing. I get a lot of questions from investors trying to discern which one might work best for them based off of their investment criteria and what goals that they have. And, you know, depending on where you're at in life and what you're hoping to accomplish, you know, one may be a better path than the other. So we're going to kind of go through maybe how you can sort of uncover which one is right for you and the pros and cons of each throughout the webinar. As always, you know, we want to get input from you guys. So if you guys have any questions as we're going through the presentation, please do just write them in the chat there. I'll take a look as we're kind of going through the presentation and answer them as best as I can. So thank you again for joining us. My name is Chris Carlson. I've been a licensed real estate professional since 2013. I originally cut my teeth in real estate in the wonderful city of Chicago. I'm helping investors by value add multifamily, and then I got into the fix and flip business for a little while. Have helped, you know, primary buyers and sellers, of course, throughout my career, but really focused on investors. I've helped a lot of my clients close real estate deals in out-of-state markets, especially including in our markets here at Marshall Reddick, which we'll jump into in a second. But I just really value my relationships with my clients and just helping them to grow wealth through real estate. I own real estate investment property myself, specifically out-of-state investment property, and I also invest in our mortgage fund here at Marshall Reddick, which we'll talk about briefly. For those of you who are new to Marshall Reddick, so who are we? What do we do? Why should you listen to us, right? We're a real estate brokerage first and foremost, but we like to look at ourselves as a one-stop shop for real estate investors. So we've got several services that help facilitate that. First is our real estate brokerage. We've got hundreds of real estate agents that specialize in helping our clients identify great investment properties all across the country in the markets that we serve. You know, we did, I want to say around 500 transactions in total last year, roundabout. We're on pace to do that again this year. 90% are investment properties, whether that's single family or multifamily. Now, I would say that's probably, you know, 10% of the battle is acquiring that deal that you're looking for. The other 90% is managing the asset. So we also have property management. We've got great property managers, maintenance managers, maintenance coordinators, leasing agents and accountants, and marketing to help facilitate the property management aspect. And obviously have a whole separate suite of solutions there. We manage about 3,000 properties now, which is, you know, tough to believe, but it's true. I'll even show you a map of all the properties that we manage. It's pretty interesting. Yeah, I would say you need property management to have a scalable portfolio. Thirdly, we've got a private money lending department. We have a lot of clients that are professional investors and they need to borrow money. I know one or two maybe on the call that I talked to before tonight's webinar that are planning on joining, and they borrow money from Marshall Reddick to help facilitate their acquisitions. Obviously, we're charging them an interest rate in return for lending them our money. On the flip side of that, we raise capital to lend out through our investment fund, right? So it's not just Marshall Reddick, the company that has all this money on its own. We have to raise capital through our investment fund to lend it out, and our capital partners receive in our mortgage fund, our investment fund, a nice healthy return each year. I'm a member of our mortgage fund, where I get a quarterly return. Now annualized, that returns around 8.5%. So if you're looking for like a really nice, stable, safe way to park cash and get a nice, healthy return, our investment fund's fantastic. We're just investing solely in residential first lien mortgages. You know, no commercial, you know, no businesses that we're investing in or anything like that. Simply just residential loans to fix and flippers, developers, professional real estate investors. So that's what we do here at Marshall Reddick. Now, I mentioned a few times that we're, in multiple markets across the country. Here's the markets that we've got agents located in, boots on the ground offices. I'm sitting in our Newport Beach office. You're gonna catch me drinking a lot of water tonight because it's a little hot for Southern California. It's like 80 degrees, right? Whereas I think in Texas, it's probably 100 degrees. Anywho, we've got offices in Newport Beach in LA, in California, and then we've got a huge footprint in Texas. That's where we manage maybe 1,500 properties across New Braunfels, Austin, Dallas, Houston, San Antonio. We also like Florida. We've got an office there in Cape Coral, and of course, can't forget Tennessee. So we've got Nashville and Clarksville there. All those markets offer, a variety of different benefits. And we can go over like exactly how we choose our markets, why those markets we feel to be, high growth and high opportunity as well on a separate call. But today we're going to cover multifamily versus single family. So we're going to look into the pros and cons, some of the unique financing aspects of multifamily, and much more conventional, obviously, for single family, how to get financing there. We're going to look at a couple of different properties that, it's tough to compare single family and multifamily pro formas, but it's a little like looking at apples and oranges. But we're going to look at similar property classes and maybe some of the benefits that each one yields. And then we'll kind of discuss property management and why property management is key to both strategies. So I do like to kind of keep this more like a Q&A, but it's just me solo up here. So I'll be asking myself questions, and these are the common questions I get from clients and just from folks that I talk with on a daily basis that are, considering a route between single family and multifamily. And so the first question, you're going to start out with, well, which one is right for me? Like which strategy aligns with my long-term investment goals? And, personally, I think it's a bit of a trick question, right? How do you know which one's going to align with your goals? Well, everybody's unique. Everybody's different. Everyone's on a different path on their investing journey. You might be, 25 years old with your first job out of college, and you want to, start in your career and you want to get into real estate investing, but, you've got limited capital, but you've also got a long runway before retirement, before you're really thinking about cash flow. Maybe appreciation and growth is what you're looking to accomplish. You're going to have a much different outlook and strategy than someone that, I'll give you an example of a client right now. They're lovely people. They own a single family house in Irvine, California. We're going to be listing that on the market for sale. It's fully paid off. They bought it, 15 years ago. It's appreciated very, very well. Obviously, Irvine's a great market for single family housing. It's actually a condo. So I'm going to probably sell for about $1 million, right? So $1 million in cash is what they're going to 1031 exchange into. But their goals now, 15 years after they bought that first investment property, right, are different now than they were 15 years ago. Okay, so now they're looking for cash flow. So where are they going to put their money? Well, they're going to look at multifamily. They maybe want to look at a different property class in a different market that has different advantages. So you really need to think about these questions that are here on the slide, which is, are you looking for income or long-term wealth? When are you looking to retire? That's going to make a big impact on whether you are thinking of single family, multifamily. How much experience you have is really essential, right? If you've got a full-time job, you're working 60 hours a week, right, in your own business, and are you really going to be buying 8-unit, 10, 12-unit buildings that need $50,000 per unit in value add out of state or even in your own backyard? Is that realistic, right? Is that too much risk? Of course, risk tolerance. And then qualifying for financing, right? Everyone's in different positions. W-2 income, a little bit easier to qualify for financing conventionally on single families, but there's a whole different ballgame and element on multifamily. There's DSCR loans, debt service coverage ratio loans, which maybe we'll talk about on a separate call, but not to get too much in the weeds on the financing aspect. But think about how you can qualify, what your credit score is, and all of this before you're kind of diving in to picking one option versus the other. Of course, what you can afford is pretty critical too. And I think before you can make a decision, you have to know what property class you're looking to buy. A gentleman that I spoke to before tonight's webinar, we were chatting about, he's in the webinar right now. He and I were trying to talk about his goals, right, that are specific to him. And he knew right off the bat what property class he wanted, right? Because he wanted a blend of cash flow and appreciation. So he wanted a B-class property. He knew that off the top of his head because he's got a lot of experience in real estate. So you really do need to understand your property classes before you make a decision on whether it's single family or multifamily, or even what type of single family or multifamily. Now, property classes are going to really project what your experience is going to be, right? Whether you buy an A-class property that's more appreciation focused, you're going to have better quality tenants. You're going to have a higher purchase price, right? Better neighborhoods, better schools, lower crime. Those are your A-class properties. B-class properties, maybe a little bit blend of both. You're going to have a little more cash flow, a little less appreciation. C-class, more cash flow appreciation, remote cash flow based. And then D-class, I like to say stands for don't do it. You're going to have more Section 8 tenants, not to denigrate that, but you're going to have lower income jobs, higher crime neighborhoods, and more repair bills, lower tenant quality, but you're going to have lower prices, right? Potentially higher cash flow, at least on paper, right? So think about what type of property class you want to buy in, and what type of maintenance and vacancy you want to have. So these percentages that you see down on the slide here are just a basis of your gross income, right? So maintenance and vacancy of 8% for A class is projected versus 10% for B class, or 13 for C class. And single family and small multifamily are going to have lower vacancy rates and maintenance because generally speaking, they're in more residential neighborhoods. They're going to have higher quality tenants for the most part, not always, but for the most part. And large multifamily, higher expenses, right? The landlord is more responsible for common area aspects, utilities. There's more turnover. If you've got a big, huge apartment building that's all studio apartments, those are going to turn over more frequently than a 3-bed, 2-bath house in a great school system where the family is going to live there for 3 to 7 years while little Johnny gets through high school or elementary school, right? They're not going to uproot their lives. Whereas a studio in a dense urban setting is going to have more turnover. Well, what happens when a tenant moves out, right? You got to repaint, you got to clean, you got to have a vacancy, you got to go find a new tenant, pay a leasing agent, and deal with all of that. So that's where the maintenance and vacancy comes into. If you want to have the lowest possible maintenance, the lowest possible vacancy, and you're more growth-based, more appreciation-focused, maybe a single-family A-class property is for you. Whereas if you're at a retirement age and all you care about is cash flow and your experience and you trust your property managers, maybe C-class multifamily is better for you. So this is what you kind of need to think about before you dive into any decision. What are the pros and cons of single-family versus multifamily for a first-time investor? Let's put this on paper. Pretty basic stuff, but I think this, once again, is crucial if you're looking at it. So why multifamily? Let's look at why multifamily might be beneficial. So you get multiple doors, obviously, duh, right? You get multiple rents growing at the same pace. That's really key, right? When you've got 2 different single-family homes in 2 different markets, they're not going to be joined up, right? That can be a benefit, but oftentimes with multifamily, it's really advantageous if you're in a growth market and you've got your rents growing simultaneously. You're charging your tenant on the first floor when it comes time for renewal an extra $100. Well, guess what? Second floor tenant's going to get the same thing when their lease comes up for renewal. Now, price per door is also substantially lower than single family rentals. Competition tends to be less fierce for multifamily. That's not always the case, but it almost usually is. Markets come in cycles, of course. Well, right now it's definitely less competitive for multifamily. Variety of reasons for that. We had kind of a multifamily boom, and then it softened as interest rates have kind of skyrocketed, and a lot of multifamily is on short-term debt. So those folks are struggling to refinance and make the numbers work, and so they're selling, right? They're going on the market and offloading. So there's more inventory, less buyers, which means you might be able to strike a better deal in the multifamily space. And just by the very nature that single family has always will have the biggest buyer pool, because multifamily is for investment purposes. Single family attracts what? Primary home buyers. So now at the same token, there might be less inventory to choose from, depending on what market you're investing in. I think this is the biggest benefit, which is value add opportunities exist in the multifamily space that can really accelerate the value of your property. Once again, we can get in the weeds here, but this is more of an intro into multifamily. But multifamily values are oftentimes based off of cap rates. Each market has its own capitalization rate. Pretty easy to figure out what a cap rate is. It's just the net operating income divided by the asset value or the purchase price. Okay. Net operating income divided by the purchase price. Right. Write that down if you didn't know what that is. And every market has its own cap rate, and those cap rates fluctuate depending on the market. But if you buy a property at in a market where it's 4% cap rates, and you buy a $1 million property, so you're getting 40 grand a year of income, net operating income, and you inject, $100,000 into that property, and you've increased the income from 40,000, the rents, right, from 40,000 net operating to 50,000. Okay, well, the cap rate remains the same. The cap rate's always 4%. So now you've got $50,000 of income. Now you divide that 50,000 into that 0.04, that cap rate. Well, you just increased the value of your property from $1 million to $1.25 million. So what you really should think about if you're looking at multifamily is what the value add opportunities are that exist to increase your income, and therefore increase the property values, and then maybe reposition the asset. Now, this is once again more experienced to assess and mitigate the risk. That's kind of a con to multifamily. There's a lot of opportunity, but there's a lot of opportunity for success and a lot of opportunity for potential missteps and failure. So think about that before you jump into it. Multifamily inevitably has a higher price point, right? You're buying multiple units. You're getting them at scale, but still, multiple units means higher price points. Income reliability is something that I've come to really appreciate as I've gotten older and more seasoned, which is if I've got a multifamily property and I have one vacancy, it's, not a killer, right? If you've got 3 units filled out of 4 or 7 units filled out of 8, you're receiving the majority of your income, right? Your rents that are able to cover and service the debt. But with a single family, you have a vacancy. It's not very pleasant, right? You've got to just stomach all of the costs and burden of your debt service if you've got a mortgage, your taxes, your insurance, up until the point you place a new tenant. So those are some of the pros and cons. Single family. Why would someone invest in single family after we just talked about all of that? Well, affordability, right? Entry point is a lot easier to get into than the multifamily space. You can buy an equivalent single family and an equivalent property class for a fraction of the price. Okay. Single families tend to appreciate a little more consistently and a little bit higher. Now, that's really just because they're the most desirable asset class in the US, right? There's more primary home buyers than any other segment of the population. So it stands to say that you're most likely to have the most consistent appreciation in single family. Now this is huge, easily tradable. This is actually why our lending team focuses on lending 80% of our loans that we have outstanding are single family homes. There's a very good reason for that, which is it's a lot more of a liquid asset. So when a seller wants to sell, it's a lot more easily traded. right? So you kind of always have to think of your exit strategy in real estate. Should be, think about how you're going to finish the game, not just start the game. And you want to think, what am I going to do in 5 years, 10 years, 15 years? And if you've got a 3-bed, 2-bath cookie cutter in a suburban community, in a decent neighborhood, you're going to find a buyer inevitably in 10 years, right? Different story with a mixed use 25 unit building in downtown Cincinnati or whatever, right? So think about your exit and think about how you want that experience to go for yourself. Primary residence buyers are always going to be more emotionally attached, right, to the outcome, to their purchase. So you can often get more bidding wars when you do decide to exit. I think maintenance tends to be a little bit less of a headache for single family for sure. And there's a little bit more of a personal responsibility aspect, I think, with single family tenants that goes under the radar. A lot of single family residents, tenants have aspirations to be primary home buyers, or they once were homeowners, right? And so they know how to maintain a property. They know how to do the landscaping. They're mowing the lawn. They're taking pride in their community, in their home that they're renting from you, and so are the neighbors, right? The neighbors are probably homeowners if you bought in a good community. And therefore it kind of maintains the value and also has less maintenance overall versus a multifamily building. Maybe not the case, right? Maybe that tenant quality isn't going to be there. And you as a landlord bear that responsibility to keep your valuable investment maintained. Okay. Which strategy will help me achieve wealth growth fastest? That's a mouthful. I guess the better question is just what's going to get me from, A to Z the quickest, right? When it comes to wealth generation. I think multifamily is probably the answer here. But it's a lot to chew, right? It's a hard to get into at first, but once you do, it's easier to scale up. So just looking at economies of scale here, we just took a couple of examples of some multifamily assets that we've seen in a market versus the average single family home price and the average rents. So for instance, if you bought a multifamily property in this market for $850, fourplex, 4 doors, price per door is only $200,000, $212,000, but your monthly income is $6,000. You only have one roof to maintain, right? One plumbing system, maybe one heating and cooling system. Single family, different story. So now you've got, say the average single family home price in that area is $300,000. You're going to have to buy 3.24 doors right here, 3.24 doors in order to achieve that $6,000 of rent. Okay. So that's 3 separate transactions, more than 3.24. I don't know, I guess you're getting a quarter of a house in this fictional scenario. But you have to buy at least 3 homes to achieve that $6,000 a month in rent goal. Now you've got 3 separate transactions, 3 separate roofs, 3 separate, communities, maybe 3 separate HOAs if you're buying in an HOA community, and the equivalent cost is significantly higher, $988,000. That's not even including transactional costs, right? Closing costs and all that stuff. So, I think if you're looking to scale quicker, multifamily is the best bet, but you just got to think about how much initial capital I have. Maybe the initial capital that you have is limited to, 25% of 300,000 versus 25% down on 800,000. How do typical returns compare between single family and multifamily properties in today's markets? Well, let's just do a run through of a couple of different multifamily pro formas. These are in different markets, so this is kind of apples to oranges, but these are honestly properties that our clients are snapping up. So this is a triplex community in Midlothian, Texas. If you haven't heard of Midlothian, it's right south of Dallas. And all these pro formas are on our website. So, if you ever want to see a pro forma, interact with one, look at properties, you can jump on our website and do so. But for this, for today's sake, let's just pick a triplex. That's a new construction community. Now, I picked different markets, but I definitely picked A-class properties, properties that are more appreciation focused. This is actually the triplex that our clients in Irvine are going to 1031 into. When they sell their property in Irvine, they're going to buy this. At least they have their eyes set on this one. So, you know, they're looking, if they paid all cash for it, they're going to cash flow a bit more than this because this has got financing attached. But when you're looking at underwriting a deal, you got to look at obviously your fixed costs. So your insurance, your taxes, your property management fees, HOA fees, utilities, landscaping. And then you also got to look at your variable expenses, right? Maintenance and vacancy and so on and so forth. Now what's below here is your 15-year annual ROI. Now, how does somebody calculate ROI? Well, it's the capital that you injected into the deal, right? In this case, it's $306,000, right? It's a healthy amount of cash if you're using financing, 30% down. Now, you just divide that amount of capital divided by the 15-year projected profit, which is principal pay down over that 15 years. It's your cash flow and appreciation. Now, you might be asking us, how do we know what the home's going to appreciate in 15 years? Well, we just look at the last 30 years of average appreciation, and actually 35-ish years of appreciation in a specific market, and then we just find the median or the average. Okay, so we're not guessing, we're just looking at, hey, this is what's happened consistently in this market. Let's just assume that this is likely to continue to grow because we're picking markets that have good economic growth, a lot of job opportunities. People are migrating to these areas for those employment opportunities. The states have good infrastructure, those kinds of things, job friendly, diverse economies, right? So in these markets, we have a good expectation that the appreciation that's consistently will consistently occur in the future. So that's how you determine your ROI. So it's a really healthy ROI here with the cash is injected, but once again, you're going to see, you know, it's cash flowing about $1,000 a month on fixed expenses. If you actually looked, it says, just so you guys aren't too confused, the mortgage interest rate is 5.25% on this particular property. It's because the seller is a developer and is buying down the interest rate. So they're paying down the interest rate, which is pretty unique for investment product, especially, you know, 2 to 4 unit product. And typically, you know, you're paying par rate, market rate, which might be 6.875, 7% for investment property. So the seller is motivated and is buying down that interest rate. This is a totally different market, totally different developer, but they're doing the same thing. This is a single family house. Look at the cost of investment capital. Now, this is also an A-class community in a market called Clarksville. Property cash needed is $111,000, 1/3 of what that multifamily is. But look, you know, your cash flow is, you know, per unit is a little bit less, right? Now, your 15-year annual ROI is a little less over here because this isn't as aggressively appreciating as the market in Dallas. Clarksville is a little bit more of a steady eddy market. I would say eventually, you know, this will probably cash flow pretty well though. You know, rents tend to increase in this market pretty healthily. So different strokes for different folks, but this is exactly what you're going to want to look at when determining what's right for you and what type of asset class. Now, we don't just sell A-class properties. We've got clients looking at 8-unit B and C class properties in our other markets. So it just depends on what you want. Now, how does financing differ for single family versus multifamily investments? Single family is pretty straightforward. They're gonna, for the most part, just look at your credit, your income, you know, they're gonna draw your blood and, you know, the hair of your firstborn child kind of thing, you know, that in-depth application for a mortgage. Now, it's a little less flexible, but more favorable interest rates, right? So down payment requirements tend to be a tad lower too, 20 to 25% on a 30-year fixed. More favorable terms for the borrower really means lower interest rates for the most part, less points, no prepayment penalties, that kind of deal. That's for the single family and 2 to 4 unit space, by the way. Multifamily is a little different. Generally speaking, you're going to have to meet debt service requirements, meaning that your cash flow needs to be greater than the cost of the debt. So, if your debt payments of $10,000 a month, you got a cash flow of at least $10,000 a month, right? Or at least have that much income, I should say. So to cover the debt. Now you have more loan products. You've got adjustable rate mortgages. You've got interest only loans, right? Where you're not paying down the balance, you're just paying off the interest rate. You might ask why that's beneficial. Well, some investors might want an IO loan because, hey, they are going to exit and reposition themselves in 2 to 3 years. They're not really caring about the principal payment 2, 3, or 5 years down the road because they're going to sell anyways. And just paying down your interest and not tackling any of that principal is going to help you with your cash flow. Maybe it's more of an appreciation play, and they like the short-term cash flow of an IO loan. Seller financing, I think we spelled that seller financing, but seller financing is certainly something that is more spoken about, more likely to occur. Commercial multifamily properties, those owners typically are a little more savvy, a little more open to seller financing, wraps, all of that stuff, where they'll carry paper, right? They will provide the new borrower a loan, so to speak, and maybe favorable interest terms. Why a seller might do that? Well, hey, maybe they want some cash injection now, but they don't want to get all of the cash and pay capital gains and do a 1031 exchange. So they'll be happy to take a little bit of a down payment from you and carry the note. So and collect interest rate payments for the next 5, 10, 15 years. So it can get a little more creative on the multifamily space from financing aspects. Tends to come with higher costs of loan points. And then you got balloon payments, early payoffs, things like that, where you got to maybe pay off your loan in 5 years, or you got to refinance. So I think about the financing component is much more prominent in your transaction in the multifamily space. Now, some people are like, well, why would I even think about investing today versus waiting? I think there is an argument to say, there might be a downturn in the multifamily space more than that's already occurred. There's definitely been a softening nationally with cap rates, meaning that basically sellers are taking less for their property for a similar income. Single family, not the case necessarily for most markets. But there's generally more inventory available today than there has been. You can look up, there's plenty of data to look at there. There's a lot more options for you as a buyer. A lot more developers, if you're buying straight from a developer, building good A-class quality product, and you don't want to have to deal with fixing up properties, value add situations, and you just want to buy something turnkey. Developers are really on the ropes, so they're offering big financing packages like buying down the interest rate, paying for closing costs, that kind of thing. And of course, you can always refinance in the future. I never advise clients to base their investment strategies off of that, but that's certainly something you can do. And if you're buying at lower pricing today, real estate's typically doing one thing over long periods of trends, and that's going up in price. So take advantage of a dip for sure. But if you can find motivated sellers, this is certainly a good time to get into the market. What question here? Which option requires more hands-on management, or is it better suited, or is better suited for professional property management? Okay, so basically, should I hire a property manager is the question. No, that's another trick question for me. I think you should always hire a property manager. I've always hired one. I work professionally in real estate, and I'm a busy person, and I'm sure you guys are busy people too. I don't like getting calls from tenants. Nor do I don't believe I'm a market expert in every market I invest in too, meaning that there's leasing agents and property managers that know more about the rents and how they've changed over time and how much to market my properties for and what the days on market's going to be than I do, sitting here in California, than my, for example, property manager, Glenn in San Antonio. If Glenn's on the webinar, thanks for doing a good job managing my house. So, I would advise hiring a property manager in either case, whether it's single family or if it's multifamily, new construction, not new construction. People are people, right? Humans cause problems. We're complex animals, and they need management. So I think hiring a good property manager is a key component to the success of an investor's goals, and also is just a key component to make you want to keep doing this, right? If you have a bad experience managing it yourself, it's not. I'm helping a client sell a property in Glendora, California right now, and they tried to self-manage for 2 years, and they're sick of it, right? And they contacted me to help them sell it, and it's because they don't want to ever invest in real estate again, and I feel bad for them. They had that experience trying to manage it themselves. And if they maybe hired a good property manager or hired anybody, they would have had a different experience and would continue to grow their investments. So think about property management. If you want to look at our fee, we're very transparent with our property management fees if you've got assets in the markets that we manage in. Obviously do a lot of education here at Marshall Reddick. So if you're interested in 1031 exchanges, interested in the new tax laws, we've got some really great, interesting webinars coming up, or just interested on, property management in general. We do webinars on management more specifically. But I hope some of this has clarified a little bit for you guys into what decision you might want to make next. Obviously, everybody's goals are different and criteria is different. So this really takes a more nuanced, consultative approach with people. So if you're interested in meeting with me, having a consultation, free consultation, of course, we make our money when you buy real estate. Really, we're real estate agents. So if you need help kind of navigating through that decision process and road mapping everything out, feel free to contact me. That's my work number and that's my email. Send me a message and we can certainly talk further about what you're hoping to accomplish. I'm going to look into the chat, see if we have any questions. I don't see too many questions in here, but if you guys have questions, email me and we will take it from there. Thank you guys so much for joining me. I look forward to seeing you guys on the next webinar. Thanks so much.